Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Pavitra Parikh. Prashant Nair is making a guest appearance.
Guest appearance. Only a guest appearance.
All right. Okay, just a quick check on the markets. 30 minutes back, we were holding up pretty well, and we were all set to say that the Asian markets are going into the Jackson Hole Symposium with strength. There was a risk on, but you can see that as the days progressed, in the first 2 hours, markets have slipped from the top of the trading session. We're off about 100 points on the Nifty from the day's high. As we've been saying for the last couple of days, the big event to track will be the Jackson Hole meeting. Jerome Powell will be speaking. The time is 7:30 p.m. India time. Now, the question, you wanted to say something? Okay. The time is 7:30 p.m. India time, and the I think you should say it.
No, go on. Go on, Reema. I didn't say anything.
All right, investors will be dissecting on the pace of future rate hikes, but will he actually come out and commit that the next rate hike is going to be a 50 basis points or 75 basis points, or will we still be in the dark by the end of it? The reason is the next FOMC meet is a good 1 month away. The September dates are 20th and 21st of September, which means there is going to be nearly 1 month of macro data for the Federal Reserve to navigate before the next FOMC meeting. So in all likelihood, while we will get a lot of important takeaways and nuances, it's unlikely we're going to get a clear picture because it continues to be data-driven. Hang Seng is another market we should pull up. That's up close to about 150 points, a 0.6, 0.7% gain on the Hang Seng. Wall Street Journal reported yesterday that US and China are now nearing a deal that could allow American auditors to travel to Hong Kong to inspect records of US-listed Chinese firms. So this is perhaps going to resolve the impasse that was there, and that's the reason why many of these Chinese firms which are listed on Hang Seng, like Alibaba, Baidu, JD.com, are all up 2 to 4%. For the markets, as I said, we've slipped from the top of the trading session. You can see cuts in names like Reliance Industries, so that's down close to about 0.5%. ICICI Bank, HDFC Limited too have seen a knock in the last 30 minutes. But talking about some of the gainers today, well, it's M&M, Tata Motors, so autos continue to do well. A couple of these commodity names like Hindalco, Tata Steel, JSW, higher in trade. And the top gainer right now is Titan with a gain of 3%.
Oh, absolutely. So that's the market right now, and we're going to keep coming back to this. But first up, quickly, let me run you through everything that we have lined up for you on the show today. The market gives up its opening gains, but still trades in the green. Metals, IT, and auto lead the gains. The mid-caps outperformed today. Nilesh Shetty, portfolio manager at Quantum Advisors, will join us to discuss his top sectoral and portfolio bets.
We'll take stock of the big global market queue. The 2-day Jackson Hole Symposium is underway. What are the key expectations on rate hike, inflation, recessionary risk, and more? Details coming up.
And delivery is higher in trade after brokerage house Jefferies initiates coverage on the stock. More details on that in just a bit.
Eicher Motors is losing in trade as CFO resigns. What's the street making of this move? Details on the show.
And Omax will be in focus on the back of new project wins for a sports complex cum retail project from the Delhi Development Authority. We will be joined by Mr. Atul Bansal, CFO and Director of Finance at Omax, to discuss more on this. So all of this and lots more coming up for you over the next 60 minutes. For now, let's hand it over to Prashant, who's waiting by with a guest.
All right, guys, thanks very much. So while we continue to talk about markets as they exist here and now, and of course we'll continue to do that, let's also turn the spotlight on how newer markets are being literally created. One of the most prominent and bold ideas in this regard has been the Gift City and the International Financial Services Center, which is present there. Let me quickly give you a brief background, and then we have a very special guest waiting by to tell us more about it. Now, what exactly is the Gift City? Well, Prime Minister Narendra Modi, back in 2007, when he was the Chief Minister of Gujarat, conceptualized the idea of the Gift City. The vision was very simply to create a financial services center that can compete with the likes of London, Tokyo, Shanghai, Dubai, etc. The place is spread over, that's a Gift City, spread over 886 acres in Gandhinagar, and it consists of a multi-service SEZ, which houses India's first IFSC, which is the International Financial Services Center. It also has an exclusive domestic tariff area. Now, just very simply put, what is an IFSC, an International Financial Services Center? Well, you know, it's very simply put, and it caters to customers outside the jurisdiction of the domestic economy. You know, so when we talk about centers like London, Singapore, etc., I mean, it kind of those are cities which come primarily to mind when you talk about an international financial center, global financial centers. A center like this deals with flows of finance, financial products and services across borders. And of course, the IFSC in GIFT now is aiming to be counted among them, the names that I mentioned earlier. You must recall in recent events with regards to the IFSC. Prime Minister was recently there. He inaugurated the India International Bullion Exchange, the IIBX there. He also inaugurated the NSE IFSC SGX Connect. That's the connect between the two stock exchanges, the NSE and the SGX there. The idea is to be, instead of a consumer of financial services from outside, to be an exporter of financial services. That's the broad vision of the GIFT IFSC. Now, since the IFSC is a place which is special, it operates by specially designed rules, so it needs a separate regulator as well. So the government in 2019 established the International Financial Services Center Authority, which is the IFSCA. That's the authority. It's a unified regulator for all IFSCs in India, present and future. IFSCA, the regulator, lays down the rules, and it also subsumed the powers of 4 domestic sectoral regulators with regards to IFSCs, which include the RBI, SEBI, IRDAI, and the PFRDA, the pension regulator. So, you know, with that brief introduction, which of course only just scratches the surface, let me welcome in the head of IFSCA, Mr. Injeti Srinivas, who's joining us right now. Mr. Srinivas, it's a pleasure, sir, for us to have you on the program here on CNBC-TV18. Thank you very much for joining us. So, you know, could you just give a very brief sort of overview on what are efforts to develop this as a global financial center at? In your opinion, how fast is this coming along? And in 2 or 3 points, if you can kind of outline to us what kind of players are making their presence now in that place. Mr. Srinivas, I think you'll have to unmute yourself, sir.
Sorry. Thank you for having me on your program, Prashant. To explain what is IFSC, I think I would like to quote from the PM's address when he was here recently. It should be seen as a gateway to connect India with global opportunities. And when you integrate with IFSC, you will integrate with the whole world. That is the broad vision of the IFSC. With respect to how it is developing, it has developed in a phased manner. 2015, actually, the IFSC at GIFT was operationalized. And from 2015 to October 2020, it was being managed by the domestic regulators, the 4 domestic regulators. So what you had was the enabling framework, which was put in place by the domestic regulators. It is in October 2020 that the IFSCA was established as a unified regulator, and it took over the development and regulation of the IFSC. In the last 2 years, there has been a significant growth in the IFSC. Just to illustrate, in the banking sector, prior to October 2020, we had only 1 foreign bank, and today you have 8 foreign banks, and you have 22 banks here with a combined balance sheet of 35 billion USD, which was around 14 billion USD when the IFSC was set up. So there is a exponential growth. Similar experience has been in other sectors like the funds, alternative investment funds. These are growing very rapidly. The 2 international exchanges here, they are also, the volumes are growing quite rapidly. So in the last 2 years, the IFSC has made rapid strides which is based on the strong foundation which was set up by the domestic regulators way back in 2015.
Mr. Srinivas, let's just take a practical example just to explain to our viewers what is the difference. Like, for example, there is, say, Stancy which operates there, or, say, Bank X, which has a presence in India, has got an Indian entity operating and sort of offering services. When we say that bank has set up at IFSC, just the mechanics of it.
Okay.
Yeah, and what is the need to be present in IFSC, and what can it do operating out of the IFSC, which it cannot do otherwise in other parts of the country? Yes.
Okay. So again, here I would say that conceptually you look at it as India as one country has two financial systems. So one is the domestic financial system and one is the international financial system. And the international financial system is operative in the IFSC. Just as we have, 200 odd special economic zones, we have one international financial services center. So it's a very unique platform where you are effectively treated as an offshore jurisdiction. So when, let us say, State Bank of India opens a branch in New York, it is guided by the regulatory framework of the Fed. And it has all those opportunities, business opportunities, which are available internationally. Similarly, when State Bank of India opens a branch here, it is like an overseas branch of State Bank of India. And they enjoy all the benefits and facilities which they enjoy at other offshore jurisdictions. Let me again put it in perspective in terms of the special benefits which banks get here. For example, look at HSBC. HSBC has been present in India for over 150 years. It has been set up here 1.5 years back. Today, it has a balance sheet of 3.5 USD, which is 20% of its India balance sheet built over 150 years. So in other words, they could build a balance sheet of this size in 1% of the time, 1% of the time they could build 20% of the business they have built in the domestic area. Being here, they can lend to the domestic economy. It will be like ECB. They can provide trade finance. We also allow things like aircraft leasing. We allow activities like acquisition finance, which are not available to the banks in the domestic area. So one is that they have the international environment. They have the benefit of full convertibility. They can access the Indian market just as they access it from Singapore or Hong Kong. They have cost advantage. They have the advantage of a unified regulator and regulations which are globally aligned.
So that example that you gave, I think that's very useful and very well explained. HSBC and IFSC is not HSBC India, but it's an offshore entity operating. And when an Indian corporate goes to borrow money overseas, and sort of arranges loans through HSBC and goes to London, etc., New York or wherever, it can do that here in IFSC via the HSBC entity at the same terms, right?
Not only that, for example, many of these banks, foreign banks, they also invest through FPIs. So much of HSBC's investments into the Indian capital market was being channelized through the Singapore branch. Now that is gradually migrating to the unit they have set up in the GIFT IFSC. So you are in a way encouraging India-centric business to re-domicile to GIFT rather than being conducted from offshore jurisdictions like Singapore or Hong Kong or Mauritius.
Oh no, that's absolutely amazing, the work that is happening. And of course, I mean, some of the growth that you outlined also speaks to what's going on. Are taxation regulations, etc., all now globally aligned, or is that still work in progress?
So see this. This we'll have to understand that as far as the Indian Income Tax Act is concerned, the entities here are domestic entities. So whatever tax regime is applicable in the domestic area is applicable here, unless a carve out has been given. And in that context, to be competitive with other offshore jurisdictions, gift units enjoy a tax holiday of 10 years over a 15-year period. So that is a great advantage they have. Second, there are some special carve-outs. For example, if you want to invest in as a non-resident in the Indian capital market, if you come through the domestic gateway, you will have to have your PAN and you will have to file annual returns. Whereas if you invest it through the gift jurisdiction, you don't have to have a PAN and you don't have to file annual returns. So there are simplified procedures to that extent. And for non-residents, especially individuals, it becomes much more easier to access the Indian capital market. It also offers similar advantages to residents. For example, now if a resident wants to invest in foreign securities, they can use the GIFT platform. At present, you don't have foreign companies listing in the GIFT because it's still early days. But recently, a very innovative product was listed in the NSE IFSC, which is unsponsored depository receipts of American securities. These are tokenized receipts which are issued here, and it is in the depository, international depository here, and traded on the exchange. So, and tokenized because some of these foreign securities, they are very expensive. They could be $2,000 per share. Now that can be fractionalized into 100 units. So you democratize the ownership of foreign securities. A lot of residents can also then invest in foreign securities and have better control, because it's just like investing in the Indian stock market. You will have complete information of what is the stock price, and you can buy, you can sell. So those advantages also are there. So on the retail side and on the institutional side, on both sides, a lot of opportunities will open up.
No, absolutely. Mr. Srinivas, glad to hear the regulatory framework, and of course, I mean, on the taxation side as well, there are enough incentives for players to set up shop there. But, you know, a financial center, of course, is made up of, at the end of the day, people, right? And international financial centers like London, New York, I mean, apart from the regulations and the tax codes and, you know, the physical infrastructure, there is also, I mean, these are also by themselves great cities. Is that also a focus area to develop this place as, I mean, in terms of just the social setting? What is being done in that regard, if you can outline for us?
Yeah, that's important, but you'll have to look at it from a different perspective. If you look at a financial center, I'm not talking about New York and London, but if you're talking about a financial center like, say, Dubai, then there's a lot of focus on you know, lifestyle and all the infrastructure and everything, because they want global business to gravitate to Dubai. There is no domestic economy per se where those players will be interested in operating. But when it comes to India or China, for that matter, the real attraction is the market, the domestic market, and the potential there. So infrastructure of that nature, I mean, of that quality, is a secondary requirement. But having said that, I don't know if you have visited the GIFT City. It is truly international standard, and it is very impressive, and it is growing rapidly. In the first 10 years, the GIFT City authorities had sold 10 million square feet of development rights, and in the last 1 year, they have sold 11 million square feet of development rights. So it shows that there is traction, and the real estate market is very upbeat. And I'm sure it will not long before international players in the retail business will also be looking at GIFT very intently.
Mr.
I
Srinivas?
also wanted to add, if you permit.
Please.
Recently, Finance Minister in a budget speech had made two announcements. One, that foreign universities will be allowed to set up their centers in the GIFT, and they'll be free from domestic regulations. They'll only have to comply with the IFSC A regulations. Second, that international commercial arbitration in GIFT City will be treated as foreign arbitration. So these two will become game changers to my mind because once you have world-class universities come up, a lot of students will also look at the option of studying at GIFT if the degree they get is the same they get in London or in New York or anywhere, because it will be far cheaper. And secondly, with the concentration of financial institutions, the job opportunities will grow. And thirdly, the link between research and industry will also strengthen. So I do see these as very positive developments. So it will not be long before that GIFT will become a compelling sort of jurisdiction and a destination for many financial players who today may not be operative here.
Fabulous stuff, sir. Thank you very much, Mr. Srinivas, for joining us and giving us your time. I mean, I do hope that the enabling environment, of course, has been presented, has been laid out, and of course, as you said, you need an anchor tenant, and then I'm talking about retail parlance, but it's a network effect. I think that's what you're referring to, and this builds and grows over the years. We hope this is the first of many conversations, and we'll have the chance to ask you what's happening from time to time at GIFT as you build this out. Thank you very much for your time here on CNBC TV18 on this program. Thanks indeed. Well, I think we'll take a very quick break here. The market is up 85 points, which means we're about 80 points off the day's high at 17,605. Take that break. We are back. Reema and Pavitra, of course, take the conversation forward.
Welcome back. You're still tuned into Trading Hour. We're around 85 points higher on the Nifty. So we have come off the high significantly, but still holding up around 0.5% in the green. Let's talk about some individual stocks now. Some exclusive information was just flashing at the bottom of your screens. Mangallore Chemicals is in news over an impending sale of shares. Nisha is here with all of those exclusive details. Nisha, what are you picking up?
That's right. In fact, sources with direct knowledge, and I have spoken to at least 3 independent sources with direct knowledge of the development at Mangallore Chemicals. Now, remember that it was bought in 2015 by Zuari Agro, and now it is looking at offloading its shares in Mangallore Chemicals to another group company, which is Chambal Fertilizer. So those stocks are at an advanced stage, is what I gather from sources with direct knowledge. They may have even hired an investment bank to advise them in this particular process, since all the 3 entities are listed on the stock exchanges. What I do gather is that Zuari Agro is looking at selling shares of Mangallore Chemicals in order to raise some funds to repay its debt. While remember that Chambal Fertilizer in the year 2015, when Zuari Agro had bought this company, was also an interested party. So this particular deal could be more in the fashion of a reorganization of assets within the same group, because Saroj Poddar, Kolkata-based entrepreneurs group, owns all the 3 companies, Zuari Agro, Mangallore Chemicals, as well as Chambal Fertilizers. So more in the fashion of reorganization, but these are all listed companies, will have to go through the processes, and arm's length transaction on the stock, on the bourses as well. Now, I also want to highlight that 54% stake in Mangallore Chemicals is held by Zuari Agro, and it was bought in 2015, and Saroj Poddar is at the helm of the entire group, which is looking at transacting this business. So Mangallore Chemicals will be in focus, and how much stake is being offloaded to Chambal Fertilizer. In my view, it could be a complete sale, a majority control to Chambal Fertilizer, so that there is distance between the 2 individually listed companies, Zuari Agro as well as Chambal Fertilizers, when it comes to the ownership of Mangallore Chemicals as a company.
Nisha, thank you very much for all those exclusive details. The Nifty, by the way, has climbed back above 17,600. Divi's Laboratories is now at the high point of the day, while State Bank of India has seen a sudden spike in its share price. But Sumera is also here with us. Hi, Sumera. Good to see you.
Hi, girls. Good morning to both of you as well. And, there's more news that's come in that the Supreme Court has ordered the partial lifting of the limit on iron ore mining in Karnataka. Ashmit Kumar, my colleague, has all those details. Ashmit.
Right, so what's interesting is that this has been a long pending matter before the apex court. Miners in Karnataka had made fervent pleas for increasing the mining caps. And what's interesting is that even the centre had backed the miners and said and argued before the apex court that to augment steel production in the country, iron ore production also needs to go up, specifically in the state of Karnataka. So in pursuit of that, we understand that the apex court had reserved the judgment and then subsequently came out with the details. Supreme Court has partially lifted the mining cap. The Supreme Court's rationale is that the concerns have to be balanced, but importantly, the Supreme Court held that lifting the cap altogether and entirely is out of question, that any change in the mining policy or in the mining target has to be done in a gradual way. So keeping that in mind, what's important is that the apex court has come out with specific targets. As far as Ballari is concerned, it had a cap of 28 million metric tons. That has been increased to 35. Similar relaxations have also been provided to the Chitradurga and the Tumkuru district. So this should come as a major relief. However, it's not quite in line with what the miners had sought in the first place. They had sought for doing away with the mining cap altogether. The Supreme Court, however, meeting them midway, allowing for partial relaxations. Back to you.
All right, Ashmit, thanks a lot for getting us all of the details from the courts now. But Nigel also joins us. Nigel, like you just heard, the Supreme Court has ordered a partial lifting of this cap. Take us through what this really means for all of the miners.
Well, there's a two-part impact out here. One is that if there's going to be additional capacity that's going to be coming on stream, then those who are consuming will be happy. But more importantly, let's focus first, on the miners. If that cap is going to be increased, we'll need to see who all, get this go-ahead with regard to increase of cap. The miners in the state from the listed space itself are NMDC. Well, they have some capacity all there. You had Vedanta as well that has a small capacity out there. And also Sandur Manganese. So all those three, they are miners. Since the cap has been lifted, in all probability, they could get to mine more as well. So good for them. On the flip side, some of those consumers, namely JSW Steel as well as Kalyani Steel, both of them have been, crying hoarse actually for the last few years or so, that availability is a bit of an issue. Yes, it's improved in the last few years, but more amount of availability of iron ore will save them on the sourcing aspect because they'll be getting their iron ore now from their home state, which is pretty good news as well. So the consumers will be happy and the miners as well will be happy. But as Ashmit said, we'll have to wait for the fine print. Back to you.
Thank you very much for that, Nigel. Get into a break. On the other side, we'll discuss market technicals. Ashish Kyal joins in next.
Hey guys, welcome back. You're still tuned into Trading Hour, and over this entire week, I'm sure we've also lost count of the number of times that we've said Jackson Hole.
If you only had a penny for the number of times we said Jackson Hole, we would be quite rich.
Yeah, and we're waiting right, for that big speech. But let me tell you a little fun fact. We all know that, every August, the Fed holds a small gathering. It's around 120 people, and they all gather in Jackson Hole in Wyoming. And if you think about it, this is such an odd choice. Why would they pick Jackson Hole, right? Of all the places in the world, they decided to pick Jackson Hole. So let me tell you a quick story. This actually dates all the way back to 1982. The Kansas City Fed was planning its annual conference, and the organizers decided that they wanted to go big this time, okay? So they wanted a big name and a big face to attend, and they decided that the best name, for this choice would be the Federal Reserve Chair at that time, that is Paul Walker. But now the question arises of how to really lure him in and how to make sure that he attends the conference. So in trying to think of ways to do that, they went after his fishing habits, not just any kind of fishing, specifically after fly fishing for trout. So they decided to hunt for a good spot. They tried several places. They went to Colorado because, it's quite a popular fishing spot. It didn't work out because apparently it's too warm in August. And they kept on looking for a good spot till they decided on Jackson Hole. It clearly worked out. Paul Walker attended the event. It was, a great success. He also went fishing. And that's how, ever since then, it's sort of become a tradition that the Fed's annual summit does take place in Jackson Hole. And, even to this date, once the conference is over, a lot of the members do enjoy going fishing. Of course, Paul Walker doesn't attend, but that tradition is in place.
Who would have thought, right?
Who would have thought?
That fishing was the reason.
But, another fun fact about Wyoming, they do not income tax. They do not have an income tax. So what money that you make, they don't have a corporate tax, they don't have an income tax. So the way they make money is through property sales, etc. And it's also turning out to be 4%.
4% because it's a national park, right?
And it's now turning into a celebrity hotspot.
Yeah.
So Harrison Ford, etc. They all have homes in Wyoming.
As exclusive as you can get, right?
All right, that's the big event to watch, and it's currently underway. And this is what all smart investors are going to be watching out for. Comments from the Fed Chair Jerome Powell on the rate hike trajectory and Fed's position on inflation. CNBC's Steve Leisman spoke to Kansas City Fed President, Philadelphia Fed President, and St. Louis Fed President to get a sense of what the stand could be.
I think when we look at the economy today, we still see imbalances between demand and supply, and that's putting high inflation in play. So we still have high inflation. We saw some easing in the July numbers, but I think it remains broad-based, so there's more work to be done. Right now, we continue to hear number one concern is a tight labor market, difficulty finding people to work, and that price pressures are still there. They've seen some easing, I think, on supply constraints, but not enough that they can look ahead over the next year and think that isn't still going to be an issue for them.
Don't know exactly yet because the data needs to let that play out. But we need to get to a restrictive stance, which we'll do by the end of the year. And then we need to see how things turn out. That is, we don't need to rush way up and then way down. We need to go up and sit for a while and let things play out. We talk about long and variable lags. We actually have to believe it and let this play out a little bit. So I want to see the next reading and then decide.
Inflation reading?
Yeah, next inflation reading. That said, I want to put this in a bit of a historical context. Since 1983, the Fed has raised rates 86 times. 75 of those were under 50 basis points. And I think we have to recognize that a 50 basis point move is still a substantial move. So whether it's 50 or 75, I can't say right now, but let's not think that 75 is not a substantial move, 50 is a substantial move.
Well, of course, we have two sides to the mandate, and we have a labor market side. And if the labor market was very disturbed, that would enter into our calculations. So that's important. I don't think recessions are all that predictable. There are models out there that try to do something, but they don't do that great of a job. And when you think about the big recessions that we've had recently, the pandemic or the global financial crisis, those were essentially unpredictable events. I wouldn't go overboard on that, but they're hard to predict events. So yes, of course, we're taking recession risk, and there is recession risk out there in the future, but I don't think we know that there's going to be a recession one way or the other.
Okay, so recession, inflation, all of these are fears, and I guess they're getting very, very real now because this Dollar Tree released earnings, and it looks like the dollar stock would soon be called the $2 stock.
I hope not, but just for the benefit of our viewers, so there are so many of these dollar stores in the United States, and we've all gone to them where you can buy toys, you buy stationery, food, merchandise, and everything sells for a price tag of $1. Now, Dollar Tree and Dollar General, these are two big stores, and I think they came out with numbers. And for Dollar Tree, it was a big miss. So the company lowered its full year guidance. The stock was down 10% yesterday. So clearly it's hitting everything, right? The small price item. But imagine this, right? For 35 years since its inception, Dollar Tree held on to that price tag of $1. Finally, in November last year, they said we cannot do it anymore. And now a lot of our stuff that we're going to be selling is going to be at $1.25. So that just shows how much it's pinching.
Yeah, and they really got a lot of backlash, right, when they decided to increase the price as well. Also, earlier this year, before this actually came out, the earnings, there was so much talk about how they've done very well because in this phase of rising inflation, they, customers flock to them because relatively, of course, they're the least expensive. So they did see good sales come through, but it's come to a point where even inexpensive products like the kind that you would find at the dollar store are being hit so hard. Rima, there was more news that came out that their apparel and home products, that is what saw quite a decline, and that's where they saw the largest decline. It's only 20% of their overall portfolio, but this is where the high margin products are, so that is why they're seeing this kind of hit in their numbers as well.
And that's why they've cut their guidance for.
I wonder if people are going to still continue going there. I mean, the whole lure of a dollar store was that anything for under $1, right? So even if you increase it marginally, will that dent sentiments enough? Or You know, people.
I don't think so, right? Because the revenues, as she said, was still very strong. It's the bottom line, which is perhaps getting hit, because now people are opting for, you know, going to these stores and buying product which are low margin for them. So clearly, in terms of
fair enough, but it's just that, you know, right now you're still going out of habit. But
Yeah,
now when you
habit.
see that it's no longer $1, and when in your own wallet $1 doesn't have the same value. I mean, let's see. It's all up in the air.
Struggle for change, right? When they start adding cents to the bill, then there would be a problem. But I guess they're all digitized, so.
Operational hiccup. Okay, a quick break. On the other side, Omax will be in focus. They've got a new project win for a sports complex come retail project.
Welcome back. Omax is on our radar. The realtor recently bagged a 50-acre project from Delhi Development Authority to develop a sports complex and a retail space. The overall investment value is seen at 2,100 crore. We are joined by the CFO and Director of Finance of the company, Mr. Atul Banshal, on the show now. Morning, and thanks so much for joining in. This is Rima here. Could you tell us a little bit more about the revenue potential? How much will you be able to generate? And what's going to be the contribution of DDA? What will be your contribution, equity, debt? Just give us the big picture.
Good morning, Rima. See, this project is basically a PPP project. We got the allotment from DDA after a bidding process. And in this, we have to build a cricket stadium, a sports facility, and in turn, we'll get area to develop retail. So the retail is our commercial play, which will fund my entire stadium and other facility that we will create. It's in a prime location in Dwarka where all the infra focus is there. We are coming up with conventions. The government is coming with a convention center. A lot of new built up. All the diplomatic enclave is shifting there. So there it's a pure. We are not raising any fund for this because capital outflow initially is not much. All the building and construction cost we expect around 2,100 crore to spend, and the entire amount will be funded through internal cash flow from the project only. So, so it is definitely a big market project for us, big branding boost for us, and particularly on an infra side where we are primarily a real estate player, but getting into infra and contributing on a sports side is definitely a big step for us.
All right. Hi, Mr. Banshal. Good morning and thanks for joining us. This is Pavitra. So you said 2,100 crores all through internal accruals. But when, what is the kind of timeline for implementing this? And also, like Rima was asking, what is the revenue potential that you see from this project? If you can help us with some numbers here.
We get to build around 7 lakh square feet of retail area. And Dwarka currently seeing the market potential, we expect that, apart from construction cost, we definitely are going to get a similar kind of revenue as a surplus from this project.
What's the revenue surplus?
So we expect at least we'll get a 50% EBITDA margin out of this project. So this is just an expectation, just the initial outlay, expectation that we have. So numbers is still we can't disclose much because we have not disclosed to given the numbers to stock exchange. So we're just trying to be conservative on this.
Saying 50% EBITDA margin, what is the revenue potential that you see from this?
So there we see at least 3,000 to 3,500 crore rupees of net revenue from this project. And after construction costs, we expect we'll be definitely with surplus of more than 1,000 crores on this.
Okay. Hi, Atul. Morning. The bigger long-term positive is the 2-notch credit rating upgrade that you have got from CARE, because now you have moved to the BBB band, right? What will this mean for you in terms of financing? Will things get easier? What is the rate you're paying now? How much do you think it might improve? And how will it help your current debt situation?
So honestly, it is a big boost for us in terms of financing. We have not raised any debt in last 3 years, except we got a funding from Varde Partners, one of the US largest PE fund. So they invested 440 crores recently in us, and seeing our numbers, we see that current other than Varde, our debt is around in a range of 14 to 15%, which is slightly much higher than what we generally raised from market earlier. So we expect at least 200 basis points of saving on our financing with immediate effect, and going forward definitely will be in a much lower band.
What's the absolute debt?
My absolute debt is 950, including Varde Partners. So other than Varde Partners, we have a debt of around 600 odd crores.
Okay, got that. Sir, if you can also take us through what is the pipeline looking like now, what are the other orders, and what is the launch pipeline looking like for all of FY23?
So this year we have around 7 projects which is lined up for launching. Primarily into Delhi, we have got another PPP project in Karol Bagh, another very prime commercial hub in Delhi. So we got this allotment from MCD. So that we are launching this year. We'll be launching Dwarka by end of this year, by end of this financial year. Apart from that, we have one project lined up in Lucknow, one in Chandigarh, and one in Indore. We are acquiring some land in Ludhiana, so there will be again a market for us to launch. Indore and Ujjain, we treated as twin city, so Ujjain also will be launching this year.
Okay. Can you give us a sense of the quarterly run rate that you're doing in terms of sales and volume? I mean, since you don't report it separately, if you can give us a trend line.
So, this financial year, we expect to touch sales of roughly around, I'll say, 2,000 odd crores this financial year. Year on year, generally, we used to have sales of 2,000 crores, except for last year, we had a little lower numbers, which we reported in our annual report as well. But this year, we expecting to increase from last year, and we'll definitely will be 2,000 crore plus surplus this year.
You're saying the revenue this year will be 2,000 crore?
No, not in terms of revenue. See, real estate revenue is a very different numbers than what you actually sell. So these are the sales numbers. Revenue on the balance sheet are different because that is purely dependent on your completion method, because we moved from percentage of completion to completed contract method. So that number will be different than what we actually sell.
Okay, just one final word. This 3,000 to 3,000 crore of revenues that you expect to generate from this Dwarka project with DDA, how much of that will you have to share in terms of revenues to the Delhi Development Authority?
We don't have to share the revenue. Okay. Our model is we have to build the sports infra and hand over to DDA after certain years. And we'll be, this retail area will be ours and we'll be selling it to our customers.
So then how have you arrived at a potential generation of revenues of 3,500?
Yeah, 3,500 is a potential generation from revenue from this. Because sports operational income we are not counting right now. Okay. Our purpose is to fund this entire project through our sales revenue of commercial and then operate it for 30 years. We want to definitely help, a lot of new teams which are coming up. Also, the local sports, adding to local sports facility. So that is our purpose right now. We are not here to make earn out of this sports infra.
So my question is, you will build a sports facility and you will hand it over to DDA. On that, you're not making any money, right?
No, so I will hand it over to DDA after 30 years. So 30 years, I have right to operate, run, and this facility, entire sports facility. So that revenue definitely will be there because a lot of IPL teams are there looking for facilities here, and we just have one stadium in entire Delhi. So this definitely will help. But right now, we're not counting that as a revenue in a revenue model of ours. Our purpose is more to...
So this 3 to 3,500 crore of revenues, will it spread over how many years?
So it will, from this project, it will come in 3 years. But this is what we expect. It will come in
retail operations?
Yes, retail operations.
In 3 years, over a period of 3 years? Okay.
Yes.
All right.
We're trading hour and the focus now shifts to our special segment, Fin Street. Operating profits have been weak in the first quarter for banks due to treasury losses and higher OPEX expenditures. Abhishek is here to tell us how Q1 panned out. Abhishek.
Well, banking sector reported a weak operational quarter in terms of operating profits, which was marked by the fact that, there were treasury losses and higher operating expenses. However, net NPA ratio of the PSU banks fell to less than 2%, perhaps for the first time in last 7 years or even more. Let's take a look as to how the Q1 FY23 has panned out for the sector. To begin with, the P&L performance, GSEC yields had hardened in Q1 FY23. This had an impact on the treasury portfolio for many of the banks, and operating profits also of the banks declined by about 9% YOY and 10.5% sequentially. For PSU banks, the operating profits fell by almost 17% YOY and more than 15% sequentially. While on the other hand, for private sector banks, the operating profits grew by a marginal 0.5% YOY and fell by 5.3% quarter on quarter. The banking sector reported net profits of 45 4,145 crores, which was up more than 37% YOY, but it declined by 9.5% sequentially. So for PSU banks, the profit stood at 16,064 crores, which was up nearly 10% YOY, but it declined by 12.5% sequentially. While on the other hand, private banks reported a total profit of 28,082 crores, up nearly 60% YOY, but it declined by 7.6% sequentially. The total restructured book of the sector now improved to 1.98% of the loans versus nearly 2.2% of the loans in the previous quarter. The lowest share of restructured book is of Kotak Bank, Axis Bank, CSB Bank, SDFC Bank, SBI as well as ICICI Bank. Now, mixed performance was seen on slippages front, was witnessed in Q1 FY23, given the fact that, slippages increased by 7.3% quarter-on-quarter for the banking sector. Annualized slippage ratio, however, increased by only 10 basis points quarter-on-quarter to 2.32% when compared to 2.22% in the previous quarter. It was a mixed performance with respect to slippages. PSU banks saw slippages decline by 4.5% quarter-on-quarter, while on the other hand, in absolute value, we saw slippages increase by nearly 28% quarter-on-quarter for the private sector banks. The good news on asset quality is that PSU banks have now reported the lowest net NPA ratio in last 27 quarters or 7 years. It has now fallen to below 2% level. So gross NPA ratio of the entire banking sector declined to now less than 6%, that is about 5.94% when compared to 6.18% in the previous quarter. And net NPA ratio of the banking sector was around 1.6% when compared to 1.7% in the previous quarter. Loan growth momentum in Q1 FY23 is perhaps one of the best that you are seeing in last 4-5 years. So with rates being increased, net interest margin is either here to stay or see an improvement going ahead. So banks will see some of the treasury losses being reversed in Q2 as yields have improved. So credit cost has continued its declining trend and may remain on the lower side over the next 1 or 2 years. So capex-based demand on corporate side is still missing from the banking sector. It will take some time to come, as much of the corporate demand this time around has come from working capital. Retail loan growth is doing good, pretty good in fact, in terms of both growth and aiding the underlying profitability of the banking sector.
Abhishek, thanks a lot for getting us all of those details and taking us through that roundup. Very interesting. But with that, we're completely out of time on this edition of Trading Hour. For now, it's around 85 points higher on the Nifty. So we have been steady for the past hour or so, around 0.5% in the green, but we have come off significantly off the highs as well. Thanks a lot for tuning into Trading Hour. Halftime report is up next.